17.5. How do we get the plan assets? Now, if you remember, the plan assets, we start off with the beginning balance, and then we would add the actual return on plan assets. That's the investment income. We would also add the employer's contributions, and we would deduct any benefits paid to the retirees. That's how we would get the ending balance. So the pension plan assets was $80 million. The return on plan assets was 5%. So they aren't specifying if that's the actual return or the expected return. But since this is a brief exercise, the 5% represents the actual return. So how do we get the return on plan assets? We take the beginning balance of 80 and we multiply by 5%, and that would be what? $4 million. At the end of the year, retiree benefits paid by the trustee was $6 million, and cash invested in the pension fund was $7 million. So we see that the return on plan assets was 5% of 80, which is 5% of 80 is what, $4 million, and benefits paid to retirees was $6 million, and cash invested, or the contributions by the employer, was $7 million. So how did they get that $85 million? Well, the beginning plan assets was given, and here we calculated the actual return, which happened to be the same as the interest cost. That's just a coincidence because the factors were completely different. To get the interest cost, you took the beginning PBO times the discount rate. Here we're taking, to get the return here, you're taking the beginning plan assets and you're multiplying by the actual rate of return. Notice that the cash contributions and the return increase the plan assets, and the benefits that are paid by the plan will decrease the plan assets. So the answer is 85. So once again, you want to be very familiar with the PBO and how it changes, and with the plan assets and how it changes. Let's move on to the next one. Brief exercise 17.8. JDS Foods projected benefit obligation, accumulated benefit obligation, and plan assets were $40 million, $30 million, and $25 million respectively at the end of the year. Now, I told you that the accumulated benefit obligation is no longer relevant. It used to be a prominent factor, but that changed about 10 years ago. So, Part A wants to know, what, if any, pension liability or pension asset must be reported in the balance sheet? Okay, the pension liability or pension asset is also referred to as the funded status. And the funded status is comparing the projected benefit obligation with the plan assets. So the projected benefit obligation was 40, and the plan assets were only 25. So let's look at the calculation here. The difference between the employer's obligation to PBO and the resources available to satisfy that obligation, plan assets, is the funded status. The employer must report the net difference between those two amounts, referred to as the funded status of the plan, in the balance sheet. It's reported as a net pension liability if the PBO exceeds the plan assets, or as a net pension asset if the plan assets exceed the PBO. So in our example, the PBO is much higher than the plan assets, so we are underfunded. Our liability is $40 million, but we only have $25 million put away in the plan, so we're underfunded. We have a net pension liability of $15 million. So if we go back up to the second part, what if instead of only $25 million in plan assets, we had $45 million instead? Now that's a much healthier plan. We owed $40 million, but we have more money put away in the trust fund. We have $45 million. So are we going to have a pension liability, a net pension liability, or a pension asset this time? Well, that's easy to see. We see that if the plan assets are more than the PBO, then you're going to have a net pension asset. So your funded status is the difference between the pension liability, the PBO, and the plan assets. If the pension liability, the PBO, is greater than the plan assets, you're going to have a net pension liability. You're going to be underfunded. If the plan assets is greater than your PBO, then you're overfunded, and you're going to have a net pension asset. Let's continue on to the next problem. Let's start calculating the pension expense. The question wants to know here in brief exercise 17.9, what was the pension expense for the year? The projected benefit obligation was $80 million at the beginning of the year. Service cost for the year was $10 million. At the end of the year, pension benefits paid by the trustee were $6 million, and there were no pension-related other comprehensive income accounts requiring amortization. So what does that mean? It means that there was no prior service cost or any pension gains and losses to worry about. The actuary's discount rate was 5%. The actual return on plan assets was $5 million, although it was expected to be only $4 million. So in order to calculate the pension expense, you have to know the components of pension expense. Well, service cost is the first component. That was $10 million. Now, the interest cost was not given. So we have to calculate the interest cost. Let's look at the answer here. The service cost that was given at $10 million. The interest cost, that's a formula. You take the beginning PBO, the $80 million was the beginning projected, it says here in the first line, the projected benefit obligation was $80 million, and they told us that the actuary's discount rate, if you look at the third line, the actuary's discount rate was 5%. So if you take the beginning PBO times the discount rate, you get the interest cost of $4 million. Now, notice that they gave us both the actual return and the expected return. Now, we need to get the actual return for the plan assets, but for pension expense, we use the expected return. The expected return was given to us at $4 million. That's a decrease to pension expense. We did not have any amortization of prior service cost or amortization of net loss or net gain. So service cost of 10 plus interest cost of 4, that's a subtotal of 14. Subtract the expected return of 4 to get a net pension expense of $10 million. So notice that if your actual return was 5 and your expected return was 4, there was a gain of 1. Okay, let's move on to the next exercise. Brief exercise 17.10, another problem where we get to practice calculating pension expense, except this time there will be an item that affects other comprehensive income. The item that will affect other comprehensive income will be prior service cost. The pension plan was amended last year, creating a prior service cost of $20 million. Now, we've seen that prior service cost will be immediately added to the projected benefit obligation, but it doesn't. The entire $20 million will not be added to, will not all be recorded to pension expense immediately. We'll have a delayed recognition. Instead, we will amortize it over the remaining service period. Back in the day, they used to call prior service called pension goodwill, because when you grant retroactive benefits to employees, that makes them feel good. There's a good chance that they'll stay with the company and be more loyal and maybe even work harder. So we take that prior service cost and amortize it over the average remaining service life of the employees. So the prior service cost was $20 million, and they tell us on this fourth line, on the average, employees' remaining service life was 10 years. So $20 million divided by 10 is amortization of prior service cost of $2 million. At the end of the year, there was a negligible balance in the net gain pensions account. So what does that mean? The beginning net gain was small and it did not exceed the corridor, so we didn't have to worry about the amortization of the net gain. The actual return on plan assets was $4 million, although it was expected to be $6 million. Now, which return do we use to get pension expense? We just saw that in the previous exercise. We need the expected return of the $6 million. So let's take a look at the calculation here together. The service cost was given at $10 million. That's always your starting point. The interest cost was given in this particular case. It was $4 million. If you remember in the other problem, we had to take the beginning PBO of 80 and multiply by the discount rate of 5% in order to get to that $4 million. Notice we did not use the actual return. We used what? The expected return is $6 million. And the prior service cost was $20 million, but pension expense gets the amortization. The $20 million divided by 10 is the $2 million. Notice that service cost, interest cost, and amortization of prior service costs increased pension expense, but the expected return was an offset with a decrease to pension expense. So our net pension expense is $10 million. Okay, move on to our last exercise, which deals with corridor amortization. Okay, brief exercise 7.